What are required minimum distributions? How much do you have to take out of your retirement accounts? And what happens if you forget to take your required minimum distributions? Plus, at the end of this video, a couple strategies to keep in mind when it comes to RMD planning. I'm Troy Sharpe, CEO of Oak Harvest Financial Group, host of the Retirement Income Show, and certified financial planner professional. So you have this retirement account, and it's money that you've been saving your entire life. For many of you, it's your largest retirement asset. And the government has allowed you to defer taxes throughout your entire working career and into retirement. At age 70 and a half, under current law, you are forced to start distributing from that IRA, and they make you pay income taxes on that. Now, it's important, I guess, to keep in mind right now that there is pending legislation called the Secure Act that could possibly increase the beginning date for required minimum distributions, but check out my video on the Secure Act to learn more about that. So, the first thing we have to do when it comes to required minimum distributions is we have to determine our required beginning date, or RBD. So under current law, it's age 70 and a half. That's 70 and 6 months. Not 70, not 71, but 70 and a half. So this is the worksheet from the IRS. It's your RMD calculation worksheet. You can find this simply by Googling IRS calculation, RMD calculation worksheet. The year you turn 70 and a half, you have to take your first required minimum distribution by April 1st of the following year. Now, be careful. If you do that, you also have to take your second required minimum distribution by December 31st of that year. So we typically tell clients that when we turn 70 and a half, let's go ahead and take that required minimum distribution this year so we don't push it into next year, have to take 2 RMDs, and our income gets to be a much higher level and possibly we have to pay higher income taxes. So once we've determined our required beginning date, we then have to determine what we have to divide our retirement account balances by. So you look at your IRA balance as of December 31st of the prior year, and you do this for each IRA that you have. You divide that account by 27.4 to get your required minimum distribution. You must then take that money out of the IRA and pay taxes on that amount. Now, the IRS has what's called an aggregation rule. So the aggregation rule simply says we have to do this calculation for each of the IRAs that we own, but we do not have to go into each IRA and take that RMD from that specific account. We can aggregate all of our required minimum distributions and choose to go in to take it out of one account or maybe 2 accounts, or if you want, you can take it out of each one. There's a strategy behind that that we talk to our clients about. I don't want to go too deep in this video. This is a beginning video about required minimum distributions, but there is a strategy behind which accounts we want to take that from. Now, we see professional financial advisors make this one mistake, and I want to make sure you avoid it. So you have to understand the difference between a workplace plan and an IRA. So a couple of times a year, we'll have somebody come in that's working with another advisor, and they say, Troy, my advisor made a mistake. So the mistake is you have to do the calculation for required minimum distributions separately for your 401k or your 403b or your 457 versus your IRAs. But then you cannot aggregate the distribution you're required to take from your workplace plan with your IRAs. So you can aggregate all of your IRAs, you can do that calculation, then take it from one, but we cannot do the calculation for workplace plans and IRAs and then take the combined calculation number from one of those. We have to take the workplace required minimum distribution from the workplace account and the IRA required minimum distributions from the IRAs. Don't make that mistake. So once we've done the calculation, it's important to note that each year we get older, okay, we have to take a larger and larger required minimum distribution. The IRS essentially wants you to liquidate that account as much as possible and pay income taxes on those distributions so they collect more tax revenue, and it's just part of how the tables work. So if we change these into percentages, 27.4 is about 3.65%. That's how much you have to take out your first required minimum distribution. At age 85, you have to divide by 14.8. That's about 7%. So each year, the percentage that we have to take out of our IRAs, it increases. If you forget to take your required minimum distribution, the IRS is going to impose a 50%, that's 50% penalty on the failure to take that required minimum distribution. So if it's $25,000, your RMD, and you don't take it, that's a $12,500 penalty that you'll owe on top of income taxes, because you still have to go in there and take it out, even if you forgot to do it on time. So don't want to miss your required minimum distributions. The penalties are extremely punitive, and we want to make sure that we take that out. One thing to keep in note here, they have this caveat at the bottom of the worksheet. It says you must increase your IRA balance by any outstanding rollover that were deposited into your IRA that were not calculated as part of the IRA account balance as of December 31st of the prior year. So if we roll money into that IRA and it wasn't there on December 31st, the IRS says that we have to add that into our IRA balance when we're doing this calculation. Required minimum distributions can be very complicated. You want to make sure that you work with a professional retirement planner or a CPA to help you figure out what is the appropriate required minimum distribution that you should take so you avoid these 50% penalties and income taxes on top of them. So one thing that we like to do for clients is when it comes to a required minimum distribution strategy, what we want to do, especially if we own stock, we want to do in-kind transfer of those shares out of the IRA and into our non-IRA investment account. But the timing of when we do this could be pretty valuable to you. So typically the market has a couple downturns every year. If we're astute about this, we want to try to take the timing whenever the market is down. If we can move those shares out at that time, okay, we're going to be able to move more shares out of our IRA, and then when the market rebounds, they're outside of the IRA, and hopefully they grow back up. So this way we're getting more shares out of the IRA, where it's a little bit of tax planning involved in this strategy that gets more money outside of that tax-infested account, and when it grows back at more favorable capital gains rates as opposed to inside the IRA, where you possibly could pay higher income tax rates. So just one strategy to keep in mind there when it comes to required minimum distributions. There are a few more, but that's what this channel is all about, is trying to get you more connected to your money, help you become more educated, and teach you some of the secrets of retirement planning professionals. So if you like this video, make sure to share it with a friend or a family member so they can learn more about required minimum distributions. Make sure to subscribe to the channel and hit that little bell icon so you can be notified whenever we upload new content, so you can stay more connected to your money. And of course, like the video, which tells YouTube to recommend it and help other people on the channel see this video as well. Thank you very much.